Let me welcome you to another presentation. And today, we are going to focus on taxes operated by individuals and businesses in Malawi. And remember, this is ACCA F6, that's Taxation, Malawi variant. And my name is Paul Mpalawi. I'm a member of the Association of Chartered Certified Accountants. And I also have a Bachelor of Accountancy degree obtained from the University of Malawi, the Polytechnic. Now it's called Malawi University of Business and Applied Sciences, MUBAS. So, taxation of employment income. Those people who are working, they are taxed because for the government to continue its operations, it needs money. And that money comes from the people in Malawi. So it is money that is taxed in several means of income. And one of the means of taxing people is through pay as you earn. So we're saying that pay as you earn is a method of paying income tax by people who are employed. So the employer deducts from the remuneration or salaries of the employee before making such payment to the employees. In other words, PAYE is a form of withholding tax. Okay? Because the employer is withholding the tax before the employer pays to the employees. And that tax is paid to the government through Malawi Revenue Authority. Then the employer remits that tax to MRA, as we're saying, on behalf of employees. This is done basically on the 14th month, on the 14th day of the following month. Okay, so we're in the month of October. So salaries for October, the employer has to deduct PAYE, and that one is due November 14th, on or before November 14th. So PAYE calculations as of August 2023. We've got a tax threshold and the monthly rate. So monthly, if you are earning less than 100,000, you're not supposed to pay tax, or your employer is not supposed to deduct tax, because that's the threshold. 100,000, zero tax. And the next 350,000 that you earn is 25%. The government takes 25% out of that. And the next 2,050,000, the government comes and takes 30% for its operations. The excess of 2,050,000, the government comes and takes 35%. It was supposed to be read 2,050,000. The excess of 2,050,000. That's our type. Okay. Now there are times when married people elect to pay taxes together. So under section 12, subsection 1, income other than earned income of a wife shall be deemed to be income of the husband. So if the husband and wife chooses to pay tax together, or the husband pays on behalf of the wife, there are tax credits that the government gives such election. So the husband is required to include in his return of income the income that is deemed to be his under section 12, subsection 1. So earned income of the wife is that income which is defined in section 73, subsection 4, as number one, an income derived from business carried on by the wife in her own right, and in which the husband is neither an employee or a partner of the company that the wife is working, or emoluments from employment received by or accrued to or in favor of the wife where the employer is not the husband, or a partnership in which the husband is not a partner, or a company in which the husband is a director who controls or indirectly controls more than 5% voting rights attached to classes of shares of the company, or a company in which the wife is a director who controls directly or indirectly more than 5% of the voting rights attaching to all classes of shares of the company, and in which the husband is employed or is also a director. So we must understand that fact. Okay, what is earned income of the wife? All right. So the question is, what would be the computation of tax liability of a married couple? So a husband is a taxpayer in his own right. That's one fact for sure. And so is a wife. Each of them is required to submit their own return of income. Okay, so the return of income of the wife will show tax liability on her earned income, and the husband's return will show tax liability on his income plus the wife's unearned income. Okay, so under section 73 subsection 3, a married couple may elect to submit a joint return of income, as we alluded earlier. If this is done, their tax liability then becomes the sum of the tax liability on income excluding the wife's earned income. Okay, remember there's earned income and unearned income. Okay, and tax liability on the wife's earned income. Sorry for that. So what I was saying is taxpayers under the joint return may, apart from the normal tax credits, claim a special tax that arises when they calculate and compare the tax computed on all income and the combined sum of taxes computed on individual incomes of the husband and wife. We've got an example where you're going to demonstrate how this come about: special tax credit and tax credit. Okay, so here's a format of how the combined tax liability of the husband and wife is computed. So we are saying all income, then there's a column for husband's income, a column for wife's income, and a section for tax credits. So we'll see what these tax credits entail. So there may be salaries earned by both. So here's a combination of wife and husband. Same with bonus, wife and husband, then the total. Then there may be an aspect of rent. Maybe these people, as a family, they have a property, or the property is in the name of the wife sometimes. So how that tax is computed, we add under the husband, and then we get the total. So in the process, there may be deductible expenses or allowable expenses for tax purposes. So donations, as per the Taxation Act, there are companies, there are organizations that are registered in Malawi. And if you make donations to such organizations in excess of 500 MK, that amount of donation that you give, it's allowable for tax purposes. It's allowable as an expense for tax purposes. So another aspect is professional subscriptions. If you are, say, an engineer and you pay subscription to an engineering body that is registered, so that aspect of subscription is allowable expense for tax purposes. Same with the repairs. You've got a house that you're renting out and you spend money to maintain that house to a good level. Then that expenditure is also accounted as an expenditure for allowable for tax purposes. So then you've got your total. Then you take your assessable income minus the total deductible expenses. What you have is taxable, total taxable income. Then you apply, then you have to apply the thresholds as we indicated earlier. You say first 100,000 per month, then per year is going to be first 1 million. Then the next is that is at zero, it's taxed at 0%. Then you say the next 350,000 per month, which becomes, if you say 350,000 per month, you take 350,000 multiplied by 12, that gives you 4,200,000. That's per year. That one is taxed at 25%. Then the next 2,050,000 kwacha, okay, per month. And if you multiply by 12, that becomes 24,600,000 per year, per annum. That is one is taxed at is it 30%. The excess of 24,600,000 per year is taxed at 35%. Okay. So what are we saying here? All other income here, you should read, includes the husband income and the wife's income. That's a typo. And secondly, we're saying wife's earned income includes the income which meet the definition of section 73 subsection 4. And the tax credits are taxes which have already been paid during the accounting period. And the amount of income in each column would be reduced by allowable expenditure that relates to production of such an income. So if you the husband and the wife might be working in different companies, and they might have already been paid, not might have, but they have, the tax that is already paid is taken as tax credits. So if you combine the earnings of the two and calculate the tax, you need to reduce it with the tax that has already been paid. Okay, PAYE is part of the taxes that have already been paid. Sometimes when you pay, when you have houses for rentals, okay, before you collect the money, the person that is supposed to pay you the rental, to you it's a rental income, they withhold a percentage of withholding tax. Okay, then they pay you. That is like you've paid your income tax in advance. That sits with MRA account, in your own account at MRA. Meaning to say, if you calculate your assessable income at the year end when you're paying, if you've paid more, then you get a refund from MRA. And if you've paid less, then you have to pay the excess. Okay. So we've got example here. Bob and Loveness are both employed in different companies as an accountant and sales consultant, respectively. Their monthly salaries are 600 Malawi kwacha and 350 Malawi kwacha, respectively. Meaning to say, Bob earns 600,000 per month, and the wife earns 350,000 per month. They both get an additional 40% of their salaries as house allowance. Their employers have deducted the necessary pay as you earn as 1,650,000 for Bob and 800,000 kwacha for the wife. And that is remitted to Malawi Revenue Authority as required by law. Other income and information. Bob has a house in Namiwawa, which he bought through a mortgage from NBS Bank. The mortgage repayment is 48,000 kwacha per month, of which interest is 42,000. Okay. The house is rented for 160,000 per month to Kabula Pharmacies. Kabula Pharmacies deducts withholding tax on payment of the rent at 15% of the rental, and that is paid to a property manager. Okay. During the year, 80,000 kwacha was spent on painting the roof and 140,000 kwacha on the new concrete driveway. We must understand here the fact that 80,000 was paid on painting, that becomes it's revenue expenditure, and 140,000 that was spent on new concrete driveway, that is not revenue expenditure, that becomes a capital expenditure, okay, by principle. So allowable for tax purposes is only 8. Allowable expense for tax purposes is only 80,000. Okay, Loveness maintains a fixed deposit account with National Bank of Malawi during the year to 31st December 2023. Interest of 60,000 K at gross was paid to the account. Here also, there's an emphasis that we need to make. By law, before the bank pays you bank interest, okay? The bank withholds 20% for bank interest in excess of 10,000 kwacha. I repeat, before the bank pays you, the bank withholds on behalf of MRIA. 20% of your interest goes to MRIA as payment in advance, withholding tax. Payment of tax in advance. All right. So number 3, Bob is the director at Lizu Limited. During the year, he was paid director's fees amounting to 120,000 gross, from which 10% withholding tax was already deducted. Okay. Loveness runs a chicken business, and for the year ended 31st December 2023, she realized a taxable profit of 2 million. That's straightforward. Required. Compute the income tax liability by Bob and Loveness respectively for the year ended 31st December 2023, and total tax payable by the two as at the end of tax year, assuming they elect to submit a joint return. So what I've done, I've simplified the calculation. Okay, then I'll explain line by line. Okay, I would love to share with you the Excel spreadsheet where I made the calculations. Let's do this. So here is the example as I've read already for you. Then our calculation, what are we saying? Bob receives 600,000. So 600,000 times 12 for 12 months. Same with the wife, she receives 350,000 times 12 months. That becomes 4.2 million for Loveness and 7.2 million for the husband, Bob. The total of this is coming up to 11,400,000. That's an annual income. Out of the two, they have already paid, if you see here, they have already paid, excuse me, they have already paid taxes. The husband paid 1,650,000 and the wife paid 800,000 as per the question. Now, house allowance. How does house allowance come about? The question says, in addition, they both get 40%. So 40% of the total income. Okay, 40% of 7.2, that's 2.8, and 40% of 4.2, and that is 1,680,000. The total is 5,650,000, 60,000 rather. So a rental received, we are told that per month rental is 160,000. So 160,000 multiplied by 12, that becomes 1,220,000. So director's fees as given. The husband, Pope, works as a director for Lizu Limited, and as being the director, he receives 120,000. That's what is received per year, and that becomes the total. Then the interest received, 60,000. This 60,000 is received after the bank has deducted 20% withholding tax. Or we can assume that if it's silent, then we can assume that there was no withholding tax. But in practice, there's no assumption. We have to inquire more. Say, but the law says A, B, C, D. Was this 60,000 received inclusive or exclusive of withholding tax? Okay. So chicken profit, chicken business, the wife received 2 million. So that one was taken as a husband income. This is an earned income, sorry. An earned income that cannot be taken as one for both. Okay, but is included in the gross. So gross income, 20 million. Income for Bob, 12 million. Income for the wife, 7 million. Total tax credits, 2.7. Remember, when they are receiving rental income, there's a deduction of 15%. So he's saying 15% of total annual rental income, that becomes 288,000. So these are the total credits as per given question. Now we need to reduce the total income with allowable deductions, allowable expenses for tax purposes. And the first one is mortgage. There's 42,000 here. The mortgage repayment of 48,000, of which out of the 42,000 was interest. So interest paid on mortgage for 2,000. Then the painting of the house, we are taking 80,000. We are not taking 140 because I am emphasizing on the fact that 140 is not income expense. It's capital in nature. So it has to be capitalized to the cost of the house. Okay. So if we take total income minus the allowable reductions, the total becomes 19,938,000. We do the same for Bob. 12 million minus 42 minus 80, it becomes 12,058,000. We are doing the same for the wife. What are we saying? Total minus 80,000, that becomes 7,800,000. Remember, we are calculating individually. At the same time, we are calculating as they have elected a joint tax return. That's an emphasis. Okay. So individually, they could have paid 3.4 for Bob, 3.4 million in tax. Sorry, this is, in tax. And Loveness could have paid 2.1 million. How did we come about with the tax? First of all, if you look at the total, we are saying the first 1 million is taxed at 0%. So 0 for total, and 0 for Bob, and same 0 for Loveness. Then we're saying the next 4,200,000 per year per annum is taxed at 25%. So if you take 4,200,000 times 25%, that becomes 1050 for both. Okay. Then the next 24 million per year is taxed at 30%. Okay. So if you take the total income minus 4,200,000, that was already taxed on 25%. What we have is a balance that needs to be taxed at 30%. We are doing the same with Bob, and we are doing the same with the wife, Loveness. Okay, that's how we came with this total here. Okay, so in summary, what are we saying? The total tax income as given here, this is total A, comes total for the two. If they elect to pay tax as a couple, this is the tax that they would have paid. Okay. However, there's a special tax credit that comes in if we take the total 5.7 minus 3.4 and 2.1. Okay, the balance is 234,000. That is a tax credit. That is an incentive for paying tax as a family. Okay, then we need to reduce with the tax that has already been paid, which is 2.4 million. Then we also have to reduce with withholding tax that has already been paid, 288,000. The balance is amount tax payable to Malawi Revenue Authority. That is 2,799,000. That's how our 2 million is coming from here. Okay, so you can copy it down and practice on your own. You can copy down the question and practice on your own and see if you're going to come to 2,799,000. Okay, let's continue. So taxes operated by individuals, income of a minor, children, and other beneficiaries. So the law says a person becomes a taxpayer upon birth. That's what the law talks about. So a minor child is a taxpayer in his own right. After you're born, you're a taxpayer. So a minor child is a child who is under 21 years of age and is unmarried. That's the definition of a minor child, a minor as per the Tax Act, Malawi. So under section 73, subsection 6, every parent is required to include in his return of income any taxable income received by or accrued to or in favor of or deemed to have been received by or accrued to or in favor of his minor child. If you're a parent, you have to include income of the minor. Okay, so let's look at gifts from the parent. Sometimes a parent would give the children, and how that is taxed, we shall see. So if a parent makes a gift or a donation or a settlement or other disposition on which taxable income accrues to or in favor of his minor child, legitimate or illegitimate, the taxable income shall be deemed to be that of the parent. If the parent chooses, so the government is trying to come up with this law to make sure that there's no tax evasion. To say, oh, but I give this child a gift and have to deduct on my tax payments as a parent. No, the government says that one is going to be taxed in the hands of the parent. Okay, no donation. An example: Mr. Banda opens savings account in favor of his 5-year-old daughter, Mona. The interest accruing on the account should be included in the return of Mr. Banda since it is deemed to be his. So there's no way you can run away from paying taxes. Okay. So reciprocal gifts: if a person makes a gift or donation or settlement or other disposition on which taxable income accrues to or is paid to a minor child, legitimate or illegitimate, of some other person, and the parent or near relative of the parent of the minor child makes a gift, donation or settlement or other disposition, or given some consideration to the person or near relative of the person who makes disposition to the minor child, the taxable income so accruing shall be deemed to be that of the parent and the minor child. Make no mistake. You make a gift to a child, okay, you as a parent become the tax payer. Okay. An example. So Mr. Banda makes a gift to James. Who is James? We shall find out. Mr. Boa's minor child and Mr. Boa's sister. Okay. Mary makes a gift to William, Mr. Banda's son. The taxable income arising will be treated as follows. Mr. Boa will include in his return the income on the gift made by Mr. Banda to James. And Mr. Banda shall include in his return the income arising from the gift made by Mary to William. The issue of gifts. You make a gift, the person who is responsible to take care of the child shall pay the tax. It shall be deemed as it is received in his own right. Okay, I hope that makes sense. Conditional settlements: if any person has made in any deed of gift, donation or settlement or other disposition, stipulation to the effect that the beneficiary of the disposition shall not receive the income or part of it until the occurrence of some event, whether fixed or contingent, such taxable income shall be treated as that of a donor until the occurrence of that event or death of the minor, whichever occurs. So there is no way you can offshore. There's no way you can run away from paying taxes. If you've made a gift with conditions, then before the conditions are met, you as the person who have made a gift or donation, you're supposed to pay tax if there's income accruing to that kind of donation. How it makes sense. That's the law. Retention of powers of revocation. If any gift or donation or settlement or any other disposition contains a stipulation that the right to receive income under deed may be revoked under the powers retained by the person by whom the right is conferred, the taxable income arising on the disposition shall be deemed to be that of a person returning the powers or revocation for as long as the powers are returned. Okay? So you, as a parent, you make a gift to a child and say, oh, but the child shall start enjoying the benefits of the gift until the child reaches some level or until the child satisfies some obligations. The donation or payment or gift shall be deemed to be for the one who has made a donation until, okay, the powers are revoked. You understand? Makes sense. So Payment of pay as you earn. As we said earlier in introduction, PAYE, pay as you earn, deducted is due on the 14th day of the month following the deduction and is submitted to MRA using Form P12. During the year end, Form P9 and Form P6 are also required to be processed. That's the summaries. Okay, how much have you made? How much have you withheld and how much did you pay? What's the balance? That is stipulated on those two forms. Okay, and these forms can be accessed on Malawi Revenue Authority website. If you so wish, you can do that. Every employer of an employee operating PAYE shall keep a record showing the emoluments paid of such employee, amount of income tax deducted from emoluments of such employee, and these records shall be available for inspection by the Commissioner General or by any other public officer authorized by the Commissioner General or on behalf of the Commissioner General at any time. You make payment of salaries, do not destroy information. Return the information. I think the maximum period to return this information has to be 5 years. So there are penalties. Penalties that are penalized to people who are doing chika, who are running away from paying taxes. So an additional sum of 20% penalty of the amount of tax which he shall have failed to pay in the first month of part thereof. You fail to pay, the taxman will come and hammer you 20%. You have to pay the tax, and on top of that, you pay 20%. Okay? Now, there's a further interest charged on the outstanding amount of tax at the prevailing bank lending rate, plus 5% per annum of each month part thereof, during which the tax remains unpaid. Okay, they take cost of capital, they take the lending rate of the bank of that day or that month. So for the plus 5% per annum, they hammer you. So it's better to pay tax than to avoid paying tax because it's easy, it's cheaper. You pay tax cheaper than playing chica stuff, and the taxman will come and hammer you. Okay, there's a note, the commissioner may reduce such amount of such additional sums of if a satisfactory explanation of the reason for the delay are made. Such additional sums will be paid by the employer, and no additional sums will be paid by the employees. So there may be times that there is a genuine reason a company didn't pay taxes. So you write the Commissioner General stipulating all your reasons. It should be it should be a discretion of the Commissioner General to say, oh, but the reason that this company is being honest. They didn't pay tax because they're waiting for, payments from other places and they were not paid. And the Commissioner General will understand and pay some penalties. But that is solely on the discretion of the Commissioner General. Okay. Leave passage, travel expenses incurred by employer on recruitment, leave, and repatriation of contract employees from countries of recruitment to Malawi and vis-a-vis as agreed to by the employer. So a leave passage may be taxed in the hands of the employer. However, the following leave passages are not taxable in the hands of the employer. Number one, an amount paid by the government to any of its employees in respect of or in connection with leave passage to a country of origin or destination. For example, engaging an expatriate from India to work in Malawi. India is a country of origin, and sending a Malawian to an embassy in Japan, or Japan is a country of destination. So there's an exception for that. Any comparable amounts paid by any other employer under a contract with the employee, which has been approved by the Commissioner General, will not be treated as accessible in the hands of the employer. Okay, so lump sum payments, these are payments whereby employees may be given lump sums on a cessation of employment. These may be gratuities, pay in lieu of paid leave, and terminal benefits. These are assessed to tax as follows. Contract gratuity, this is paid to an individual who was employed on a contract basis. So the gratuity is included in the assessable income. Now, let's look at fringe benefit. What is fringe benefit? So as per Section 2 of the Taxation Act defines FBT, that is fringe benefit, as any asset, service, or other benefit in kind provided to an employee if such benefit includes an element of personal benefit to the employee. Okay. Section 94 of the Taxation Act states that every employer other than the government of Malawi who provides fringe benefits to any of his employees shall be liable to pay fringe benefit tax on the total value of fringe benefit tax, on the total value of such a benefit, as such a fringe benefit, at the rate specified in the 11th schedule, subject to and in accordance with the regulations made under the same act. So FBT is paid by the employer, but cash benefits paid to employees are taxed in the hands of the employees under pay as you earn, as we saw earlier, where house allowance was paid directly in cash. It's different to when house allowance, when you're given a house, when you're given a house by your employer, whether the house is finished or unfinished, there are different rates that are used. Okay, so every employer shall, within the month in which he begins to provide fringe benefits to employees, register with the commissioner for the purposes of these regulations, and at the same time shall do so by completing a fringe benefit tax form, FBT form, set out in the schedule obtained upon application thereof by the employer. So calculation of the FBT is as follows. Number one, you need to identify the fringe benefit being provided by the employer. Number two, you need to determine the taxable values of the fringe benefit. Number three, you take the taxable values and you hammer 30%. So the skill comes in determining the tax values of the FBT. That's when we are trying to teach you how to do the same. Very, very simple. You just have to follow the law. Okay. Determination of the taxable values. Calculation of the taxable values of FBT is specified in paragraph E of the 11th schedule to the Act. So under housing accommodation, if the housing is owned by the employer, what do you need to do? At the same time, you need to check if the house is owned by the employer, the taxable value of the fringe benefit is the greater of the following, the higher of, the greater of. Number one, the open market value of use or the rental value of such property, or 10% of the employee's salary if the accommodation is unfinished, or 12% of the employee's salary if the accommodation is finished. So you need to take the higher of the three. Open market value, 10% of the employee's salary if the house is unfinished, or 12% of the employee's salary if the house is finished. B, if the house is, this one was supposed to be read as is. Sorry for that. So if the house is rented by the employer, the taxable value is the greater of the following: the rent paid by the employer, or 10% of the employee's salary if the house is unfinished, and 12% of the employee's salary if the house is finished. Okay, determination to continue. Sometimes an employee may be given a motor vehicle. So what is the taxable value of the motor vehicle? The taxable value of the motor vehicle provided as a fringe benefit is 15% of the original cost without restriction to business use only. If the vehicle is restricted to business use, such that you use the vehicle from your point of your accommodation to office, or you use it during office hours to move between your office to some places that you've been sent, or you are going to do a job for the company that you're working for, there's no any fringe benefit. There's no any personal gain to that. But in other companies, they say they give employees cars and they give them maximum 4 years. If they're still working with the company, they say, okay, the vehicle becomes your vehicle and you can use anyhow. There are no restrictions. That's when the personal gain element comes in, chips in. That's when the company has to account 15% of the cost, including it as a taxable value for determination of FPT. School fees, sometimes a company may pay for school fees of your children or immediate family member, as it may please the company and as per the contract. So for school fees and related expenses paid by the employer directly to institutions, the taxable value shall be 50% of the cost of the employer. 50%. But if the school fees is given to you, an employee, in cash, it changes everything. It becomes your earned income and it's taxed in your hands. So it's good to pay directly to the institution. So other fringe benefit tax, for other fringe benefits, the taxable value shall be the entire cost of the employer. These other fringe benefits include, but not limited to, utilities such as electricity, water, and telephone, household items of any kind, vacations, travel, and any other provisions, domestic service of any kind, such as gardeners, maids, cooks, nannies, and or housekeepers, security guards, and watchmen. That is straightforward. Interest-free and low-interest loans. When the interest rate charged on a loan given to an employee by the employer is lower than the commercial lending rate of the banks, the difference between the actual rate of the banks and the commercial rate is taxable as a fringe benefit. The actual rate given by your company and the commercial rate charged by the bank, the difference in between is taken as a personal gain, and that is taxed as a fringe benefit. This does not include educational loans, emergency advances, including loans for medical bills and funeral expenses. Remember, this is the rule. And when you're examining you on the understanding of the tax law. So keep in mind of this. If the loan is an emergency or an emergency advance given to employee, sometimes there can be some emergencies in between, and the company would think of giving you an advance. That is not a benefit. Okay? It's not taxed. There's no any fringe benefit. Okay? Payment of fringe benefit tax. The FBT is payable in quarterly installments and is due within 14 days from the end of the first quarter. So every quarter, 1, 2, 3, 4. January, February, March, April. So the government calendar starts the July, August, September, October, November. July, August, September, October. Okay, first quarter, then so on and so forth. So each quarter, July to September, July, August, January, February, March, April, May, June, July, August, September, first quarter, October to December, second quarter, January to March, third quarter, April to June, fourth quarter. So FBT for the first quarter shall be due on the 14th of October. FBT for the second quarter shall be due on the 14th of January. So if 14th of January is a holiday, you have to pay before. because it's due on or before. So there's no excuse. It was a holiday, so we didn't pay. Hey, taxman doesn't play, chief. I'll come and hammer you. Okay. Records to be kept by the employer for the purposes of the fringe benefit tax. Obviously, an employer is required to keep records showing nature of the fringe benefit provided, names of the employees receiving the fringe benefit, the taxable values of fringe benefits as determined in accordance with the rules discussed. We discussed the rules. So if you commit an offense, the following are the main offenses which may be committed in relation to FPT. Number one, failure to register within the required period. You've started paying fringe benefits to your employees and you fail to register. There's a problem. Okay, you'll be penalized. Failure to pay fringe benefit tax as due on a due date, there's a problem. If the offenses are committed, the employer shall be liable to a penalty of 20% of FPT due. The penalty must be paid together with the fringe benefit due. So all the discussions that we've had on this topic, I've taken it from the Taxation Act, Chapter 42, Malawi, that's 2022, and the ACCA F6 Malawi Taxation, that is 2023. And I also use the Malawi Revenue Authority website. You can check for yourself, www.mra.mw. I submit. Good luck.